Are you looking for the best stocks to buy in July? I've got you covered. Today I'm going to cover 7 growth stocks that I think are attractive at these levels and lower. This is going to be a rapid fire video. I'll provide the stock pick, a quick overview of the company, some fundamentals, and we'll look at a chart for each stock as well. Let's dig in. The first stock is Tesla, and Tesla is set to report record quarterly vehicle deliveries fueled by incentives. So Tesla is expected as early as this weekend to report global deliveries of 444,000 vehicles in April to June. That would be an increase of 5% from the 422,875 in the preceding quarter. And you can see this has been a nice trajectory upwards for Tesla's deliveries. So Tesla has been cutting prices aggressively since January, and there's some concern there about eroding margins. And of course, that's one of Tesla's differentiators, higher margins than those legacy car makers. Tesla raised discounts in the second quarter for vehicles in its inventory to a $1,600 to a $7,500 range. It also made all of its Model 3s eligible for full federal credits of $7,500 starting in June in the US. Tesla is also set to increase China's sales by 13% from the previous quarter to a record number of vehicles. Now, some analysts are concerned with this, that lower prices would weigh on the margins, which has prompted some brokerages to downgrade Tesla stock. And for some, that overshadows a recent stock market rally that's been driven by a flurry of deals by automakers to use Tesla's charging stations. According to JD Power, Tesla chargers are more reliable than competitors. 21.6% of EV drivers using non-Tesla charging stations couldn't get any electricity. On Monday of this week, I did a deep dive on Tesla on the channel, and I talked about GM and Ford and others, how they're getting on the Tesla standard for charging. And Tesla's another step closer to dominating the charging infrastructure. So Volvo just recently announced that they're going to be the latest EV maker to embrace Tesla's North American charging standard. That includes arrangements already made by General Motors, Ford, Rivian, and others, including just yesterday, Polestar EV, which will get supercharger access in 2024. And although this seems bullish on the surface for most, some analysts are cautious. And there's a quote here: the biggest risks of opening the charging network, in our opinion, are potentially losing Tesla car buyers to other OEMs and decreasing current Tesla owner satisfaction. This is according to Goldman Sachs. And I can see both sides of that argument, but for me, I think it's bullish for Tesla. It's showing us that Tesla has created something that's going to become the standard. And in my opinion, it really solidifies Tesla's name recognition. The argument there is, if you're going to buy a Tesla, I don't think you're going to change your mind necessarily and go to a Ford just because Ford can use Tesla chargers. Now, we knew this was coming for some time. I did a video comparing NIO and Tesla, and I talked about the fact if you ever buy a NIO in the United States, you're probably going to use Tesla superchargers to charge it. Now, if you watch the video on the channel Monday, I'm bullish on Tesla for many reasons. Not just electric vehicles, but also solar, battery storage, robo-taxis, moonshots like Optimus, their robot. I look at Tesla as a green energy conglomerate. I had a VIP call today with a member, and he asked me, what ETF should I buy for green energy? And my answer to him was, honestly, buy Tesla. When you look at those ETFs, there's so many individual names that I personally wouldn't buy the individual stocks. Really bad balance sheets, just really bad fundamentals. Tesla has solid fundamentals. Let me show you more. I'll also look at a chart. Now, according to Fidelity, the PE ratio is 75.81. But what you have to remember here is that this is a trailing 12-month PE ratio, not the forward PE ratio. And with growth stocks, you have to be careful looking at that TTM PE. And it's definitely not the only metric you use to evaluate a stock. Now, Tesla has run hard, like a lot of these growth names. The 52-week range, 101.81 to 314.67. So this stock was just $102. Now it's $262. But let me show you why I think it's still a buy even at these levels. So the price to sales, 9.44. It's expensive. Price to book is about a 17. Expensive. PEG ratio, 7.67. Expensive. But here's where it gets more interesting. 74.5 PE for this year's estimate, but next year's estimate is 52.9. Now, 52.9 is not dirt cheap by any means. And I'm not necessarily in the camp of Kathy Wood, where I think it's a $2,000 stock by 2027. Ron Barron says it's going to be a $1,500 stock by 2030. I think that's possible. So if you're looking for a long-term investment in a high-quality growth company, Tesla still fits the bill. Every single Wednesday, we do chart day in Patreon Discord. When you see orange, that's a previous chart day. Yellow is today's chart day. I'm just going to talk through it today, so you're not going to see yellow. But the last time we met, just this Wednesday for chart day, and also the same information I covered on the recent YouTube video. So below $239, you could see 222 and 212. I think those would be opportunities to buy, but I don't think that's actually going to happen. I've been saying if it holds $239.40 support, that it's probably going to go higher, and you're probably going to see $300. That's that red line line up here. Now, of course, it doesn't mean you go all in, and there is some risk here. It's not a cheap stock. But if you're thinking 3 and 5 years out, I think the stock's gonna be worth more. And if it pulls back, it's an area to dollar cost average and buy more shares, in my opinion. Earlier this year, I did a 12 stock portfolio video that was focused on growth stocks in different sectors. And one of the stocks I included was Celsius. And I got a lot of heat for it, a lot of questions like, why would you do that? Why would you include that? You usually talk about secular growth trends in technology. What do energy drinks have to do with that? Well, energy drinks certainly are not technology, but they are a secular growth trend. There's a positive compound annual growth rate, and more people globally are drinking energy drinks, whether you like it or not. Now, we bought Celsius for $85 a share. In Discord, it was a great buy. The stock's trading over $150 today. But there's another company that's much larger that you might not have looked into in the past. And it's been a monster performer, pun intended, Monster Energy. Now, when I started researching Monster, I was blown away by the number of products they actually own. If, for example, I had no idea that Monster already owned Rain. And this company is a rabbit hole. I'm not going to spend a lot of time, but I thought this one was interesting here. This is showing you the energy category. This is total US dollar share. So this dark red line up here, this is Red Bull. Celsius is down here in the yellow, and you can see it's ramped up a lot. There's been a lot of growth there, and the stock has been performing off of that. And then Monster is this green line up here, and you can see it's kind of flat. Now I'm going to share some news here in a couple minutes that could help accelerate that a bit. So Monster has distribution partnerships with Coca-Cola system bottlers. And you can see in the red here, it's pretty massive. They also have the green there, that's all other or independent. But Coca-Cola gives them nearly a global presence. Monster is now distributed in 142 countries and territories. I had no idea. Strategic brands are now distributed in 63 countries and territories. Rain is now in 25 countries and territories worldwide. Affordable Energy, Predator, and Fury, which I'd never heard of before, is now distributed in 34 countries and territories worldwide. So one or more of the company's energy drinks are distributed in a total of 157 countries and territories worldwide. So this company is based in Corona, California, and you can see some of the brands here on your screen. So the energy drink market is growing at a compound annual growth rate of 8.2%. This is from 2022 to 2031. And this is by type, alcoholic and non-alcoholic. Now in the orange here is 2020, the blue is 2031. They have kids here showing over double growth for kids, which is a little bit interesting. Adults, huge number there. Teenagers also over doubling. So all three of these are projected to grow over double by 2031. We're talking about 8 years. And when you go to a convenience store, there are a ton of different brands there, and you think, well, look at all these different companies, but Monster actually owns several of those brands. If you look at leading energy drink brands in the United States, this is 2022 based on US dollars. Red Bull is the dominant one. Monster is the close second. Then you've got Bang Energy, you've got Rockstar, and then you have Rain. Now, Rain is actually owned by Monster Energy now, and Bang right here, surprisingly, news today. Monster close to buying rival Bang Energy for $362 million.
Bang Energy is all about being manly, like sipping cotton candy. Time for a key bump. Creatine Ultra COQ10. Cock 10. Why do I drink Bang? Because my coke dealer's in jail for life. Guess what I had for breakfast? Bang. Guess what I had for lunch? Bang. Guess what I had for dinner? A felony.
So Bang Energy maker Vital Pharmaceuticals said in a Wednesday court filing that the proposed sale to Monster is supported by its lenders and represents the only viable path. So the FTC has held this up and is requiring more information, and it might not get passed. But if it does, Monster already is right here in this line. They'd be acquiring Bang, which is this third line, and they already own Rain. So really it's just Red Bull and Rockstar, which is pretty small by comparison. Of course, companies like Celsius aren't even on this list because they're smaller and growing, and there's a lot of hyper growth in Celsius. I do like that stock, but you might be surprised at the valuation when you look at Monster. Let's dig into it. So Monster right now shows a 38.2 PE ratio on Fidelity. Again, that's trailing 12 months. Stock's trading at 57.49, 52-week range, 42.81, 60.47. This is a large cap, $60 billion. It only has about 1.3% short interest, so not much at all. Price to sales is 9.27. That's not cheap. Price to book, 8.13. PEG ratio, 1.83. That's not too bad. And the PE based on next year's estimate is only 32.1. Now, of course, that's not cheap by any means, but as I showed you, there's a lot of total addressable market for energy drinks, and you can see the growth here. This is going back to 2009. This goes all the way back to December 31st, 2009, and you can see it's it's just been a steady climb upward. Now, the year-over-year quarterly growth does have peaks and valleys. It's a little bit seasonal there. We can see it's still trending upwards overall. And I think that this company will continue to grow. And I actually think that Bang Energy acquisition could be big for Monster because they have that global network and they could sell Bang in all those different countries and territories that Bang doesn't currently have access to. So looking at a chart, Monster was only $35.89. This is back in March of 2022. And it's been on a tear. It's trading just under $60 a share right now. Now, I'd like to see this stock come down a little bit. My preference would be $55 or less dollar cost average, but that might not happen. It's consolidating. It's probably going to hold up around $56.50 in this range. You can see it's trading just below the 50-day moving average, this yellow line. The red line here is the 100-day moving average, and this purple is the 200-day moving average, so it is above the 100 and 200. But if the market stays bullish, I think this could hold up around $56.50, and it could pop up a little bit higher. So this is a Fibonacci retracement here you've seen on the channel before, and these are Fibonacci pivot points. Now, usually they're used for swing trading. We're really using these to try to get better entry and exit points for long-term investing. We're generally holding 5 or more years. If this holds up and pops, I think you could see it break above this and extend. This first line here is about $61 in the R2, and this R3 is up here around $63. Now, I've been bullish on this stock since the IPO, and recently I've seen a lot of buzz about it online. A lot of people have been asking me questions. The company is Hashicorp, ticker HCP. Now, what does HCP even do? So their products enable collaboration and automation in IT. That's a really simple way of explaining it. This company is a rabbit hole. And if you want a deep dive, drop a comment below. I'll be more than happy to do that for you guys next week. They enable users to define infrastructure as code from development, test, and security through to deployment logic and infrastructure configurations for operations. So these products support numerous cloud and private infrastructure types. So on-prem, cloud, and hybrid cloud. So this is their stack. You've got application, networking, security, and infrastructure. Our products represent the standard for cloud infrastructure automation workflows for teams and a system of record for enterprise cloud programs. Thousands of companies use HCP to provision, secure, connect, and run cloud infrastructure to support their mission-critical applications. So they have 4,392 customers. They have 830 customers that are 100K ARR, that's annual recurring revenue or more. And you can see some names down here: General Motors, Grab, Comcast, Progressive, and so on. So last quarter highlights, 37% year-over-year growth. Now, this is an open source company, so it's not a true software as a service. Part of their business is going to be in that SaaS, that recurring revenue, but a lot of it's also bolt-on and services and things like that. So this is very unique and not compared the same as like something like a CrowdStrike or a Datadog. Their net dollar retention rate, 127%. And they're saying that their total addressable market for calendar year 2026 is $70 billion plus. And this is a great snapshot to show you the opportunity for the company at each layer. So everything from database, messaging, security, infrastructure, and so on. You can see some companies that you're familiar with like Confluent, Snowflake, Databricks, MongoDB, and you've got the different products over here with the Nomad, Console, Vault, and Terraform. And this announcement just happened this week. Hashicorp acquires Blue Bracket to add secret scanning. And just from a high level, in a nutshell, what this is really going to do is complement existing products. Customers can easily scan, identify, and address secrets hidden in their source code, development environments, etc. Now, this stock was $21.50 back November 9th, 2022. The 52-week high was $44.34 on August 12th, 2022. So this is trading at $26 a share right now. So HCP bottomed out November of 2022 at $21.59. It then popped up to $37, pulled back, popped up to $36, pulled back. So this stock really kind of likes to trade in this range, and you can see the range has been pretty long here. So you really have this channel and these red lines, and it was following a trend line, this blue trend line up, and it did pop up, but it's come way back. This is off of earnings. Now, what's interesting is earnings surprised by 48.35%, and revenues actually surprised to the upside slightly at 3.62%. But this is one of those companies that is more severely impacted by the macro, and I still think there are some headwinds in front of this company. From a valuation perspective, this isn't a true SaaS company, so it's hard to compare it to like a CrowdStrike or a Datadog. Now, Snowflake is consumption-based. That thing's trading over a 20 EV NTM revenue. The EV NTM revenue on HCP is 6.6x. Now, it is below the rule of 40, and it doesn't have positive free cash flow, so this one could be in the penalty box a little bit longer. This is a long-term investment where I really see it accelerating over the next 5 and 10 years. I do think this can be an important player, and at under a $5 billion market cap, it can even be an acquisition target. It's not necessarily a reason to buy it. This is something that Tony C., who's a developer in our Discord community, brought up the other day. So for me, I've been saying, I prefer this stock if it's $25 or less, accumulate 25 to 30. I've been saying this for a while. DCA 25 to 30, you're in that range now. And this is several chart days ago. For the stocks I follow closely, chart days have been absolute fire. If you want to join us for a chart day every single Wednesday, check out patreon.com/firedupwealth. You can join our Patreon Discord community. So I think it's possible this stock could come back and retest 21. It could always even go lower if we go into recession or something like that. Overall, the macro data has really been improving though. We had some more inflation data this morning that was a little bit better than expected. I think this one could bottom out soon. If it goes below $25, it's a DCA area. I still like it even at 26 bucks a share. But this is not a hyper growth stock that's going to give you 100% returns in a year, anything like that. This R3 is up at $40. So it could get up to that $40 range, in the next 12 months. That's very possible. But I want to reiterate that this is more of a speculative stock and it's a long-term investment, 5+ years holding. Now, I just did a deep dive on the channel covering CrowdStrike and SentinelOne as well. And you can check that out when this video is over. I'll put some cards up at the end. But one thing I wanted to point out here we didn't cover last time, our large and expanding TAM. So that land and expand methodology or that approach that you hear about in SaaS. So as CrowdStrike adds more products, it's going to increase that net-based dollar retention. It's also going to increase that TAM. So 2023, they're saying their total addressable market is $76.1 billion. In 2 years, that compound annual growth rate 13% at $97.8 billion. So just under $100 billion in total addressable market by 2025. CrowdStrike, again, it's endpoint security. It's best of breed. It has several competitors. Its primary competitors will be Microsoft, SentinelOne as well, but SentinelOne is more focused on SMB. I'm going to show you some additional data on CrowdStrike that I did on the last video, and I think this is going to surprise you. You're going to want to see it. So we know the 52-week range, it got down to $92. It's $147 now. And you're thinking, well, I don't want to chase it. I get that. It doesn't have a PE ratio. It says 0 on Fidelity. I get that too. It also is expensive at a 13.84 price to sales. But again, that PE ratio is the trailing 12 months. So based on next year's estimate, it's showing here a 46.8. So CrowdStrike has come into profitability. And just to give you a visual here, you can see it goes back to April 2022. This blue line is revenue. This yellow line is net income. You can see it's in the negative here. And then all of a sudden this last quarter, it's basically flat. So net profit margin, 0.07. This is up 41% on the revenue growth, 41.97%. Previous quarter, up 47.88% here. But it was negative profit margin. Go back another quarter, up another 52%, negative profit margin. Go back again, up 58%. Go back again, up 61%. This company keeps delivering over and over, just crushing it, giving you 50%, 60% quarter over quarter. So on that previous YouTube video, I told you that I liked the stock under $150 DCA. It's at $147 now. It's really following this trend, and I think it's going to pop higher. And again, for all of these, that's assuming that the market continues to remain bullish. If the market rolls over, these stocks can roll over as well. And we're really thinking about these from a long-term investing perspective, holding these companies for 5 or more years. But this R2 is up here around $174. This R3 around $192. I think it's going to consolidate around these moving averages. It's kind of sitting right above that 50-day moving average right now. I think it'll consolidate and run up. That first stop is the R1. It's about $164. R2 is $175. R3 again, $192. So for me personally, if this continues to do well, if they have a PE ratio, next year, I think this stock could easily be $200 or more in the next 12 months. And a 46.8 PE ratio might sound expensive, but remember, this is recurring revenue. This is very different than a company that has to go to bat and get more revenue every single quarter. They've got revenue that's simply coming in every quarter, every year that's recurring off that software as a service model. Just to provide some perspective, Salesforce CRM has less growth than CrowdStrike, and it's trading right now at a PE ratio at 556. Of course, both companies are going to have that recurring model. But you could argue that CrowdStrike is still inexpensive considering it's going to have more growth than a Salesforce CRM, and in a year, it could be trading at a 50 or 60 PE ratio. I recently did a deep dive on C Limited as well, and I encourage you to watch that after this video. So most of these stocks that we're talking about today, I have deeper dive videos that will go into much more detail. And we talked about some of the earnings highlights. It's slowed down with its growth, but that total net income has actually gone from negative to positive. The adjusted EBITDA has gone from negative to positive. It's sitting on $7.2 billion in cash and cash equivalents. The Shopee e-commerce has 36% growth. The big hit here is really going to be in gaming. Garena, digital entertainment. Fell off a cliff a little bit here, basically cut in half. That's why the stock's being punished. But let me show you some interesting metrics on C Limited that we didn't talk about before. So this stock, 52-week range, $40.67 to $93.70, trading at $58.21 right now. It doesn't have a PE ratio, but again, that's the 12 months trailing. Market cap, $32.24 billion. Now, price to sales ratio is 2.48. That's not too bad. Price to book, 5.27. The PE based on next year's estimate, 23.5. And there's me right here, the Motley Fool article I did a week ago on C Limited, down 80% from its highs. Very similar to CrowdStrike, where you've got the revenue in the blue, the net income in the yellow. You can see on this, the net income is actually positive, and it has been here for a couple quarters. It dipped a little bit from the previous quarter. The difference here is this company is not experiencing much growth. It only has 4.88% growth. So net profit margin 2.9, but that growth isn't very good. Only 7% here, 17%, a little better, 29%, but negative profit margin of 31.65. But the point here is that even though the company's growth has slowed down, it's becoming profitable. So if that growth reaccelerates again, goes the other direction, you could see this stock really take off. Now, my preference here was really $50 or less. A lot of people in Discord were buying around $45. It popped from $42, $40.67 to the low, all the way up to $88.39, fell off a cliff, kind of found its footing again around $56.05, and now it's trading at $58.12. So it kind of popped up and came right back. So you could see a potential double bottom formation coming here, and it could pop off of that. It certainly could go lower. This S2 is around $47. If it gets below $50, I think that's the sweet spot where I really would add heavily. But I do like this stock, $60 and under DCA if you're thinking as a long-term investment. And there's certainly some risk with it, but the company is becoming profitable. And like I said earlier, if they can figure out how to fix Garena and some of that growth, this stock could really take off from these levels. It's not really an expensive stock at these prices. Now, I've got two more stock picks. Before I go on, if you're new here, subscribe to the channel, click that bell for notifications. My goal for this year was 40,000 subscribers. We've already surpassed 41,000. Let's try to get 50,000 subscribers in 2023. And if this video is helpful, drop a like and drop a comment. I do a video like this every single month, so you'll want to subscribe to make sure you don't miss the next one. And if you're interested in dividend stocks, a couple of days ago, I did the exact same format for dividend stocks. Go check that out. And as I mentioned earlier, most of these stocks I have deeper dives on. So go check out some of those videos at the end of this video. I'll put some cards up for you. And I do need to announce that this video is sponsored by the Motley Fool. If you'd like to see the 10 best stocks to buy now, visit fool.com/firedupwealth. And if you want to join our private community Patreon Discord, visit patreon.com/firedupwealth. This stock I have never talked about. Not on YouTube, not in Discord. I've never talked about it. I'm looking for some fintech plays that I think are attractive. Now, this is a global leader in fintech, 25 years in business, so it's very established. It processes $200 billion plus annually, over 200,000 current customers, 500 plus tech integrations, 3.5 billion annual transactions, and 7,000 plus sales partners. And right now, they're really just in a few countries, and it's primarily in North America and Europe. This quarter, we added several new signature merchants, including a mega resort in Arizona, as well as the Chicago White Sox, the Washington Commanders, and two large Las Vegas properties that they're not permitted to disclose. Additionally, we signed an agreement with Six Flags theme parks to use our software and payment technology for their food and beverage operations. This is one of those white glove kind of behind the scenes companies you don't know much about, but they're doing pretty well. This stock currently trades under a 20x forward free cash flow. That PE ratio is 56.39, that's trailing, and the company is Shift4 Payments. The ticker is 4. Now, this stock has run hard like many of these names. It was $29, now it's $68. The 52-week high was March 31st of this year at 76, and I think it's going to go back to that level and probably higher. This company is doing well. Revenue growth, 36%. EPS growth, 69%. Revenue growth over 3 years, 39.69%. 5 years, 28.88%. Cash flow growth rate over 3 years, 241.99%. Cash flow growth over 5 years, 166%. You probably haven't even heard of this before. I'm going to go through some valuation metrics in a chart. Before I do that, if you want to look into this company more, some of the competitors would be like Fiserv, that ticker is FI, Global Payments, which is GPN, and then you've got like PayPal and Block. So price to sales ratio on 4, 1.76, not bad at all. The PE this year's estimate says 28.2, next year's estimate 21.5. Now the growth rate for this company has slowed down significantly from the pandemic, but it's starting to stabilize. And projections show that it should have somewhere between 35 and 40% growth over the next 12 months, which is still really solid for the valuation. This is one of those stocks that nobody really talks about or knows about, and it could be a hidden gem. Now you have to be careful chasing with this stock and most stocks right now, but I'm not just looking at where the stock's been, but where it could go in valuation. And I'm looking looking at this saying it's not that expensive, even though it has run from $29.39. So it's one thing if it's a hyper growth stock and the valuation doesn't make sense, but if the company has popped really hard, has rallied really hard, and the valuation still makes sense and you can build a thesis around it, that's where I decide, well, this is still a possibility to buy. There's certainly some risk there because a lot of investors piled into this name at a much lower level than you did. And if things go south, they can sell from underneath you and you could come down back in these levels. And that can happen with any of these stocks. And that's the risk you take when you really are investing in a bull market after a big surge that we've seen. So you can see it's holding this red trend line and it's really making higher lows. So 55.93, 57 and change, 58 and change, and so on. It's really trying to hold up here. You can see it bounced hard off that. These are very bullish daily candles. It's now above that 50-day moving average. And I think you could see it come up to the $75 range in this R3. On extension, maybe even $78 or $80. I would love to see this stock come below $60. I think that would be a great opportunity, but I think it's probably going to go higher from here. The ideal opportunity here is really at that $60 price point, but it bounced really hard, really fast before I could even get this video out. I've been working on this for a few days. Unfortunately, it popped here over the last couple of days, but I do think it can extend from that and go a little bit higher. If it does pull back to these levels or lower, I think that's the opportunity where you really want to be adding more heavily. June 20th headline, Etsy's going to buy back $1 billion more of their shares, and they're a $10.57 billion market cap. So that's significant in my book. And the Forward PE ratio on this is under a 20. Now, I covered Etsy on last month's video as well, and I said then $85 or less DCA, the lower the better. It's trading right now at $85.59. You would have an opportunity to buy it at $80.44, kind of at the beginning of last month. As a long-term investor, I actually like this stock $100 or less, but 85 or less, in my opinion, if you don't have a position, it's a good place to start a position in dollar cost average. This is not just a pandemic play, and I don't think it's going to go anywhere. With that said, I understand it's a love-hate stock and it might not be for you, and that's okay. Do me a favor, guys, go check out another video. I've got a deep dive on Tesla, on C Limited, on CrowdStrike. Check out one of these cards here and go watch another video, or go to the homepage at Fired Up Wealth and explore the different videos. I've got playlists as well. But if you're looking for these type of companies, you want due diligence, I have much deeper dive videos on individual stocks. Go check those out. If this video is helpful, drop me a like, drop me a comment, subscribe to the channel. I appreciate your time and attention. Have a great rest of your day. Take care.